Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Monday ends in the green on Wall Street. We saw stocks slip earlier in the day as investors watched news of global trade tensions increasing. It's the first trading day of June, which traditionally starts out strong and can soften by the end of the month. Today, major indices all ending up. And Zscaler seems to be shaking off the cybersecurity slump. We're speaking with the company's CEO on what it's doing to be successful against competitors. And the success of Mag 7 stocks boosted gains in a big way for the month of May. We're taking a deeper dive into those wins for investors and the markets. Well, Zscaler shares have been soaring as of late after reporting stronger than expected results for the third quarter. Joining us now to break down those numbers and discuss what's next for the cloud security company is Jay Chaudhry, Zscaler CEO. Jay, it is always good to see you. So, first time, Jay, we've had the chance to catch up with you since you reported earnings. I was just looking, Jay, at the analyst commentary off your print. They talked about, Jay, strong results. They said outperformance across the board against what they characterize as high expectations. So walk me through the quarter, Jay. What are you seeing in the business?
So Josh, good to be back. The quarter was strong in all areas. First of all, the top line was very strong. We are approaching about $3 billion in ARR. Our operating margins are strong. In fact, we achieved a Rule of 40 performance for the 21st quarter in a row. And what's Rule of 40 performance? If your top line growth, the revenue growth percent, plus the cash flow margin, the two together are over 40%. You are in that rare group of companies. Last quarter was 52%. So we're not only good in top line growth, we're also running the company in a meaningful fashion. And this is happening because we're delivering great value to our customers.
I was reading some analyst commentary, Jay, who cover your company and the broader universe. And I thought it was interesting how they talked about, Jay, that you look resilient. You know, in the face of this macro pressure, macro uncertainty, you all look resilient. In contrast, they said, to some other cyber companies which were reporting, slipped sales, challenging sales cycles. How do you think you're pulling that off, Jay, and remaining relatively resilient?
So Josh, cyber is important for customers, for the board, and we do zero trust architecture while lots of other security companies are built around firewalls and VPNs. So when customers are looking for better security, they want zero trust architecture. But that's only one part. The second part was even more important. Today's world, macro is tight. There is deal scrutiny. CIOs are being asked to reduce the budget. CISOs are working on tight budget. We are one of the very few companies that can cut cost because we are zero trust security. In the Zscaler world, our customers do not need all these firewalls, VPN, network access controls. We are able to reduce the cost while giving better security. That's why when the market is tight, Zscaler can deliver good results.
I'm curious, Jay, you won't be surprised to find out we spent a lot of time talking about tariffs on this show. It's a big topic for investors, obviously. Do you see any impact in your business from tariffs, Jay, and tariff policy?
So customers do think about tariff. From Zscaler point of view, we see very limited impact because tariffs will impact vendors who ship lots of boxes. Many security vendors ship boxes. Zscaler is not in the box business. We are a pure cloud security service. So the tariff impact is limited. But having said that, we do see tariff as a concern for our customers. So as their budgets get tighter, they're going to ask for optimization and cost for cybersecurity and other IT products. Since we can reduce cost, we become a good player to help our customers when tariffs create uncertainty.
We mentioned, Jay, your stock at the top. It is worth noting the move it has made. It's up about 60% already this year. You're up nearly 75% over the past 12 months. How much time, Jay, do you spend thinking about that as the CEO?
Honestly, markets go up and down. We focus on our customers every day. Our employees build great solutions. It is good to see market recognizing the value we bring to the table, but customer solutions, making sure we help them. I want Zscaler customers to be far safer than customers who are depending upon firewalls and VPNs. Today, I'm sitting in Las Vegas. We are starting Zenith Live, our annual user conference. I just came out of a meeting that 30 customers, these are CIOs, CISOs of Fortune 500 companies. They're sitting there. They're so proud of what they've achieved with Zscaler. That's what makes me happy. That's what makes our employees proud. So we keep on innovating new solutions. It was zero trust before. Now we are combining zero trust with AI. AI is powerful. AI is needed badly. And AI is only as strong as the data that trains it. Zscaler, having 50 million plus users, creates tons of proprietary data that can be used to secure our customers. So customer obsession is one of the key values. It starts with me, and that's what we do every day and every evening.
I'm curious, Jay, as always, to get your general take as well on just the general threat landscape, Jay, what you're seeing, how it's evolving, how your company is positioned to capitalize.
So the threat landscape is fairly tough. It's getting worse and worse. But you would expect that because when business is happening online, everything is going online, your critical infrastructure, the bad guys do want to go there. So it's not unexpected. But I think what we need to do as providers, as customers, to step up and shake off some of the inertia. The number one reason for why companies are getting breached is because inertia is holding them back. They think that the network and security with the firewalls and VPNs I built years ago is good enough. It's not good enough. Hackers have no inertia. So enterprises who are moving forward quickly, making changes, adapting new technologies are in a better place. We can beat bad guys, but we must be proactive about it.
Jay, always great to see you and to have you on the show. Thank you, sir.
Josh, thank you. I really appreciate it.
Well, U.S. stocks close higher to start June as investors shrug off a flare-up in U.S.-China trade tensions, and Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got to start with the major indices. Just a continuation from what I was talking about at the bell. The majors are in limbo, and let's take a look at what I'm talking about here. Excuse me, because I just noticed this is a year-to-date chart, and you look at this period here. This is exactly 15 trading days, so basically 3 weeks worth of data, all sideways action. And let's zoom in a little bit with a 2-month chart. I'll put some candlesticks, and you can see that is a whole lot of not trending action right there. So that's the S&P 500. Here's the Nasdaq, broke a little bit above on those NVIDIA earnings, but that was given back the next day or by the close of that day. Here's the Dow, very similar story. And by the way, here's the MAG 7, the MAGS ETF, very similar. Here's XLK, the tech sector ETF. Here's NVIDIA itself, driving the bus. Now this looks like it's upward sloping just a little bit, but the bottom line is we're still looking for a catalyst here. And interestingly, I just had a conversation with Cole Smead, CEO of Smead Capital Management. This is for Stocks in Translation. The episode is being dropped tomorrow, and he drew an interesting comparison to history about stocks and bonds. Let's take a listen.
At the bottom at 09, you could look back 40 years, okay, and bonds had beat stocks over the prior 40 years. I mean, just fathom that for a quick second. Bonds had beat stocks over the prior 40 years.
I remember Rosenberg bringing that stat up too in 2009. So.
Correct. And a local New Yorker, Jim O'Shaughnessy, I remember seeing his data on it, and he talked a lot about that. And I point that out because, again, everybody, the old saying is do not confuse brains with the bull market. And yet, ...
Well, that's exactly what we
always do.
So markets sometimes roll over. I've been talking about all the bullish things in the market, the seasonality plays, the comeback, how close we are to highs, but we are potentially in an area where we could roll over like 2001. I'm going to be talking about that on Catalyst tomorrow.
Is there any question to you that tariffs remain the number one risk for the market.
I have a chart. I'm glad you brought that up.
Yes.
So my next point is VIX equals tariff uncertainty, and just check out this chart here. This green line here, right here, is the VIX volatility index. This goes back to the beginning of the year. In white, we have the Bloomberg Global Trade Policy Uncertainty Index, and these two have been in relative lockstep much of the time, and we got some divergences here, but they're pretty small. So tariffs have been the news here, and the VIX is just kind of participating and reflecting that. And in as much as the stock market, the S&P 500, is the VIX upside down, stocks are just really a reflection of trade policy. Now you take this back to prior years, it does not hold. This is a recent phenomenon, so I can tell you it's probably all Trump here, and that's why we pay attention to these headlines from day to day. Bring it back to point one though, guess what? We haven't had a major breakout in 3 weeks, so we're still waiting on that ultimate catalyst.
Dollar, week today, walk us through that, the ripple effects we need to think about.
You bet. The dollar dove today near 3-year lows, and the metals are surging. And so one of the consequences of having yields surge, that can happen in two ways. You can have real yields or break evens. And I don't have time to get into it here, but let me just show you what has been surging today. We got silver up 5.5%, and there you go. That's the intraday. Let me just show you the year to date. Broke to a 2-month high, and it looks like that's almost, it might be the intraday highs of the year. Definitely on a closing basis. I don't think we've seen anything higher. And then we also have copper. Copper up almost 4%, very similar. Hasn't quite broken to the same level of highs, but definitely at 2 months highs right there. And then got to throw in some gold, right? We got GC equals F, 2.72%. It's just been consolidating near these highs here. And look, it is within spitting distance of that ultimate high, $3,500.
So silver, copper, gold. How is the dollar like a diamond?
Oh, that's a good question. I threw this one to ChatGPT. It says, if you cut too many corners, it loses value. There you go.
There you go. That's what you pay for.
Yes.
Thank you. Thank you, Jared. Stick around. Much more Ask for a Trend still to come. Sportsbook operators under pressure as Illinois introduces a tax hike on wagers. Lawmakers passed a budget that includes a tax of 25 cents per wager on the first 20 million online sports bets. After that, the tax rate increases to 50 cents per wager. For more on what this does mean for sports betting, let's get to Citizens Senior Equity Research Analyst. That would be Jordan Bender. Jordan, it is always great to see you on the show. So these names were under some pressure today, Jordan. Let's look at DraftKings was down about 6%. Flutter finished down nearly 3%. If I'm an investor, Jordan, I have capital committed to these two names. How worried should I be? What is it going to mean for their bottom lines?
Hey, Josh, good to see you as always. You know, we left Friday work not expecting really anything coming over the weekend. And less than 24 hours later, DraftKings and Flutter, they got hit with some pretty big tax increases out of Illinois. You know, and the reaction today from investors, and you can see it in the stocks here as well, is this was just really out of the blue. This wasn't expected. And that's a little bit of the scary part is we've seen tax increases as part of this industry, and that's expected. And it's all kind of done on a flat tax. The flat tax just comes up. This was done more on a graduated tax basis. And this is the second year in a row, which has caught investors off guard. You know, the scary issue here is the line of sight behind some of the tax increases are starting to get shorter and shorter. Illinois, this happened in less than 24 hours. It wasn't on anyone's radar. These companies will have to work through how do they adjust the business models, but you know, we're market outperform on both of those names. We're bullish on the industry. We think there's ways to actually offset some of these tax impacts, which for DraftKings, we estimate will be about 80 million a year, and Flutter will be about 85 million a year on an annualized basis.
Those ways to offset it, Jordan, those levers you think they could pull, walk us through it.
So historically, what we've seen is you take costs out of the cost structure. Sales and marketing comes down. Some of the technology costs might come down. I think this time around, given this is Illinois, it's the second year in a row this has happened. The effective tax rate now is over 50%, and these companies are getting to the point where on a Illinois P&L or even a New York P&L, they're not making all that much money anymore, just given how high the taxes are. So on the surface, there's ways to offset this. You make people bet more. You make people bet more parlays or longer leg parlays. And the last interesting point here, which I've had a lot of discussions with investors here today, is we see this with like the ride hailing apps with Uber and Lyft, where they'll actually show you the actual surcharge or impact for every ride on your receipt. Investors have been kind of throwing that idea out there today of putting on your bed slip. Illinois implemented 25 cents for every wager, and then beyond that, there's actually a 50-cent step up as well. But just showing the end consumer, this is what the state has done. The messaging so far today and yesterday from DraftKings and some of these sports betting operators is they're more willing this time to just pass it off to the consumer and not necessarily take the hit themselves. So a little bit change of tone this time over historical tax rate increases. But we kind of talked about the gross impact for DraftKings and for Flutter. We don't think you'll come anywhere close to that. And I think the consumer is going to take a lot of the brunt here of that.
Do you think that could mean then, Jordan, more consumers, more customers make a move to unregulated sports books?
That, the reason to legalize sports betting and iCasino in states is to bring people from the offshore markets onshore. And the harder you make it, the harder that the states make it for these sports betting operators to provide a fair and competitive product, the experience gets worse. And kind of the net result of that is players do look to go back offshore if they're not getting the level of free promotions or the experience that they want. And some of the adjustments that I talked about with the sports betting companies looking to pass this on to the consumer, at the end of the day, that's just going to make the experience worse. And we do have some data that shows after the first tax rate hike in Illinois back in July 1st of 2024, the amount of people betting onshore has gone down. So people left to go offshore. We fully expect if and when this goes into effect on July 1st this year, this second tax increase, we're going to see people move back offshore. It's going to be worse for the consumer. It's going to be worse for the states, and it's going to be worse for the sports betting operators.
DraftKings and Flutter, why are both those names, Jordan, in the red so far in 2025?
It's really, what we've discussed here today. It's a lot of regulatory risk, a lot of regulatory overhang. We're losing really sight or line of clarity on what's going to happen 6 months from now from a tax rate perspective. Illinois was out of nowhere, but we still have states like New Jersey, Louisiana, North Carolina. Investors and analysts are kind of sitting here waiting for the states to decide, are they going to actually increase those during their respective budget processes? So that should happen in the next couple of weeks as well. The other side of it is, game outcomes have been bad, and that's just part of the business model. NFL, rewinding NFL, it was a historically bad, stretch of period for the sports betting operators. All the favorites won going into the new year. March Madness, all the number one seeds continued to advance. That's not good for the sports betting companies. So it's been really a function of estimates have come down across these companies. But we would point to, again, we're still optimistic on the direction of travel here. We would also point to, like Genius Sports or Sport Radar, really the data suppliers or the technology companies that aren't prone to these changes within the industry. They're benefiting from guaranteed revenue within the sports betting industry. So that's how we prefer to own the names here going forward.
And I know you mentioned, Jordan, you got the equivalent of a buy on both those names, DraftKings and Flutter. If I pushed you, would you say there's one of those two you prefer a bit more?
Yeah, I think at this point, we like Flutter over DraftKings. The whole thesis of like U.S. online gambling expansion, like that moved the stocks a lot back in that 2022 to 2023 range. But now that we have some of these embedded risks left in the sector and kind of the questions about what happens going forward, at the end of the day, Flutter is a global company. It's the largest gambling company on earth. Over 60% of the revenue still sits in major markets outside of the U.S. So it's a little bit of a hedge of you don't get the full impact of what happens here in the U.S., but you also benefit to the upside as EBITDA and cash flow continue to inflect from here.
Jordan, always great to see you and to have you on the show. Thank you.
Thanks, Josh.
Stick around. Much more Ask for a Trend still to come. Well, the Magnificent Seven tech stocks returning to dominance in May. We're taking a closer look with our chart of the day. Yahoo Finance's Julie Hyman joining me now with a closer look.
The S&P 500 just chalking up its best May in 35 years. The reason? 2 words: Magnificent Seven. Yes, indeed, they are back and really contributing once again. Remember the debate that we sort of continually have? Does the S&P 500 rely too much on large cap tech for its gains? Well, I'm not going to opine on that, but it definitely accounted for a lot of the gains in May, 62% to be exact. That is according to research from DataTrek. And here is the breakdown in index points of the contribution each of the components made. Now, Apple did not contribute. It actually took away a 1/10 of a point from the S&P 500 during the month because it was down. But otherwise, we saw big gains and big contributions from the likes of Microsoft and even bigger, NVIDIA, even Tesla, which, as we know, has been a decliner year to date and has been taking away from gains. Even it saw the gains in the month. So overall, you get that 62% of the S&P 500 overall in terms of the index point gains that we saw for these large cap tech companies. So it really was a comeback. Another way to look at it is to look at the ETF that tracks these companies. And you see here, and I know Jared Blickery has been looking at this, the 2-month chart for these stocks. We can also take a look at the sort of year to date to see where we are and where we have come. So we've made this round trip, but we haven't made it all the way back to where we were at the beginning of the year. We're pretty much flat. And we've been talking to investors about this. Are these stocks now priced correctly given the outlook? Should people get in here? Of course, there is a large range of opinions. We talked to Kenny Paul Carey earlier on the show, and he said in terms of stocks broadly here, you still want to be cautious because of some of the trade negotiations, the uncertainty about how that's going to turn out. We also talked to Ted Mortensen of Baird, and he says we really want to pay close attention to these companies' second quarter and third quarter numbers, the ones that really start to incorporate the effect of the tariffs as they have started to impact their bottom line. So that's something to keep an eye on here to see where the Magnificent Seven go from here. One of the things Mortensen pointed out, however, is that CapEx remains intact. In other words, big cap tech continues to spend and continues to spend on itself. NVIDIA, as we know, has been one of the primary beneficiaries. Josh?
Thank you, Julie. And that is wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.